In our monetary system, the currency supply is regulated by central banks. The purpose of a central bank is to maintain the price stability. But stability does not mean that prices don't evolve. For the ECB, prices are stable if the consumer prices rise at a rhythm of under but near 2% per year over the middle term. We name this rate inflation rate. When we talk about consumer prices, it refers to a typical bucket of goods and services that are usually consumed. In this basket, prices are weighted in order to fit some arbitrary consumer behavior. This does not mean that it is the same for everyone, and maybe the goods and services you buy evolve differently. Especially, only goods and services for consumers are considered. Expenses like production costs do not fulfill these requirements. This is also true for housing. The level of the rents in the euro area represents an important part of the price bucket, but valuations vary a lot from a location to another. And only rental prices are considered, not flats or houses to buy. For example, accessing home ownership has become much more expensive over the last decade, but it is not the role of the ECB to avoid this. What the middle term means is not well defined. A typical value can be something like between 3 and 5 years. Because it is not precisely defined, it gives the ECB a certain freedom of interpretation. According to the equation of exchange, the price level can be determined from the amount of currency in circulation, its velocity, and the quantity of goods and services produced. The central banks can regulate the supply of currency. To do so, they have several instruments, but the most traditional one is to set the short-term interest rate. Other important tools are printing money to increase the monetary basis or longer-term rates. The reserve ratio is another leveraging tool of the central bank. It refers to how much money a bank should keep when you have a checking account. The bank may loan the rest out, which increases the amount of money in circulation. This increases the level of prices. On the opposite, when you withdraw money from your checking account, it reduces the amount of loans the bank is allowed to sell. This reduces the amount of money in circulation and hence, indirectly, the price level. Thank you.